A quick recap of our discussion on this topic. We have explained the capital structure of a company shows the different types of capital the company uses to carry out its activities. This can include ordinary share capital, preference share capital, debentures capital, and other types of capital. We explained initially that capital is the money used to create a business, to build a business, and to run a business. We explain risk, business risk, financial risk. We now look at capital. There are two major theories of capital structure. We have the traditional theory of capital structure. The traditional theory states that there is an optimum level of capital structure for every company. I'll take that again. The traditional school of thought argues that there is an optimum level of capital structure for every company. This optimum level of capital structure is achieved at a point of gearing where the weighted average cost of capital is at minimum points. Let me take that again. The traditional school says the optimum level of capital structure is achieved at a point of gearing. What is gearing? At a point of borrowing. When we use gearing, it means borrowing or taking debt. At a point of borrowing where the weighted average cost of capital is at the minimum level. Once a company achieves the minimum level of WACC, then that company has reached its optimum capital structure. The rule says once you achieve optimum capital structure, then you must maintain that capital structure. You must maintain that ratio. At any point in time, you want to raise additional finance. Your additional finance should be in the proportion of your capital structure. That is the proportion of equity to debt or debt to equity. That is the position of the traditional school. We now have Modigliani-Miller. Modigliani-Miller theory says that capital structure decision is not relevant. Modigliani-Miller theory of capital structure states that capital structure decision is not relevant. A company can decide to finance its business with equity capital, or you can decide to finance your business with debt capital, or you can decide to finance your business with a combination of equity and debt. How you finance your business will not affect your market value. How you finance your business will not affect your cost of capital. Hence, according to M&M, capital structure decision is not relevant to companies' market value and companies' cost of capital. The company's capital structure will not affect your market value, will not affect your cost of capital, provided there is no taxation. Their argument is based on the assumption that companies will not pay tax. It's a tax-free economy. They now develop a formula or a model to support their argument. The model was, we have like 3 formulas that says that the WACC of a geared company is the same as the WACC of an ungeared company. That is, the cost of capital of the geared company is the same as the cost of capital of an ungeared company. The value of a geared company is the same as the value of an ungeared company. Provided there is no tax. The cost of equity of a geared company will be higher than the cost of equity of an ungeared company. We explained this at our last class. We now have Modigliani-Miller allowing for corporate taxation. Some years later, Modigliani-Miller revised their initial theory to include corporate taxation. The inclusion of corporate taxation significantly changed their conclusion. They argue that with corporate taxation, let me go to that aspect of the, we are just trying to do a recap. Okay, look at it. With corporate taxation, a geared company will have a value greater than an ungeared company. What is a geared company? A company financed by equity and debt. The value of a geared company will be higher than the value of an ungeared company, because the geared company will enjoy tax relief on debt by business with debt capital. You are going to enjoy tax relief on interest payable on debt capital. This tax relief will be used to reduce your cost of capital. Reduction in your cost of capital will enhance the value of the company, will increase the value of the company. If your cost is reduced, then your value will go up. Hence, they also supported this argument with two propositions. Proposition 1, the WACC in a geared company is lower. The weighted average cost of capital of a geared company will be lower than the cost of capital of an ungeared company, because the geared company will enjoy tax relief. That tax relief will be used to reduce the cost of capital. Hence, we have this formula. WACC of a geared company is equal to WACC of ungeared bracket 1 minus dt divided by d plus e. Next, value of a geared company is equal to value of an ungeared plus debt multiplied by tax. Lastly, we have the cost of equity of a geared company is higher than the cost of equity of an ungeared company. Here we are going to introduce tax to the formula. We explained this last week. Thereafter, we solve a question on this topic. Tonight, we shall take one more question to round up the topic. But before then, I don't know if I've explained what is beta. Let me try to explain what is beta, types of beta. The next 10 minutes, we should be round up with this explanation. What is beta? If you look at it, when you are computing cost of equity using CAPED, the formula includes beta factor. Then the question is, what is beta? First point, beta is an index that measures, beta is an index that measures the level of systematic risk. Beta is an index that measures the level of systematic risk. What is systematic risk? Risk that cannot be avoided. So beta value is an index that measures the level of systematic risk of a company's equity. Almost every time we reshare this material on the platform, we have 3 types of beta. We have what we call the asset beta. We have equity beta. And we have debt beta. Let me quickly say that this topic I'm taking, capital structure, is closely related with cost of capital computation. It will assist your understanding of how to calculate cost of capital. The more reason the two lecturers, we are taking the topic simultaneously. The one is taking you guys cost of capital computation. I'm taking you guys capital structure and theories of gearing. All right. I've explained beta, the index that measures level of systematic risk. What is systematic risk? Risk that cannot be avoided. A good example is inflation. Inflation risk. Look at Nigerian economy. Whether you invest your money in banking sector or you invest your money in construction company or you invest in telecommunication company, inflation is in Nigeria. It will affect all the companies. It will affect all the investments. That is the risk that cannot be avoided. We now have three types of beta. We have asset beta. Asset beta is also known as ungeared beta. Please, you may jot down. You may jot down. Asset beta is otherwise known as ungeared beta. This beta measures the level of business risk of a company. Asset beta measures level of business risk a company is exposed to. It shows the business risk of a company. Number two, we have equity beta. Equity beta is an index that measures the combination of both business risk and financial risk. Equity beta, an index that measures the combination of business risk and financial risk. And it is otherwise known as geared beta. For example, if a company is financed by equity and debt, that means the company will have business risk as well as financial risk. Business risk has to do with the nature of your business. Financial risk has to do with debt financing in your business. So if a company is a geared company, that company will have business risk as well as financial risk. Equity beta is an index that measures the risk of a geared company. There's a formula for calculating asset beta and equity beta. I can go to the distance. There's a formula there. Obviously, we are going to show it, Kevin. This is your asset beta formula. Just 1 minute. Just 1 minute. Because it's a topic under cost of capital. I don't know if you have gotten there with the first lecturer, Adejumo, okay? You see it now. Let me place it here, near me here. Let me put it here. No, no. I need to share. All right, look at it. Asset beta. It relates to business risk. The formula is stated here. BA is equal to BE multiplied by value of equity over value of equity plus value of debt into bracket 1 minus tax plus BD multiplied by value of debt bracket 1 minus tax value of equity plus value of debt bracket 1 minus tax. Do not be disturbed by the noise of the formula. It's usually provided at the back of your question paper, but you must know how to use it. BA represents asset beta. BE represents equity beta. VE represents market value of equity. BD represents debt beta. VD represents value of debt. Your letter T represents your tax. This formula will be provided at the back of the question paper. Look at equity beta. The systematic risk of a geared company. You can calculate as BE is equal to BA plus bracket BA minus BD, close your bracket, value of debt over value of equity multiplied by 1 minus the tax rate. This is your asset beta. Always remember, equity beta has to, sorry, asset beta, business risk only. Equity beta has to do with business risk plus financial risk. Now we now have debt beta. Your debt beta is an index. Your debt beta is an index that measures the risk of a company financed by debt only. In reality, no company is financed by debt only. In reality, no company, no business owner will finance his business 100% by borrowing. For this reason, the debt beta is usually assumed to be zero. For this reason, debt beta is usually assumed to be zero unless the examiner states otherwise. All right, I've explained these three things because when you get to cost of capital computation, you might require it. What determines returns to investor is the level of risk. One major factors that determine returns to investor is the level of risk. There are other factors, but one major factor that determines return on investment is the level of risk. That level of risk is measured by beta factor. The risk could be business risk or a combination of business risk and financial risk. If you are talking of business risk only, then you look at asset beta, otherwise known as ungeared beta. If you are looking at combination of business risk and financial risk, then you talk about equity beta, otherwise known as the geared beta. All right. We have tried to detail the explanation. Please refer to your study pack. Question number 2. Cooper PSC. Cooper PSC. Please refer to your study pack. Let us deal with question number 2. Please confirm you have this open on your study pack or your system. Somebody is asking that they do reshared. The ones you are in classroom, you might not look at your phone again. So you should have asked for this. Can somebody help us reshare? But as soon as you enter the platform, you should ask them to give you the material. All right, let's go on with the class. It's okay, it has been reshared. Go to, I'm not sure of the page. What is the page, please? Who have opened the page?
Page 149.
Page 145.
149.
Okay, please, page 149, question 2. Okay, page 149/150. Question number 2. At 150. Question 2. All right, let's move on with the class. Let's go on with the class. The finance director of Copper PSC is concerned about the impact of capital structure on the company's value and wishes to investigate the effects of different capital structures. He is aware that as gearing increases, the required return on equity will also increase. And the company's interest cover ratio, interest cover, is likely to decrease. A decrease in interest cover will lead to change in the company's credit rating by the leading rating agencies. He has been informed that the following changes are likely. We have interest cover, credit rating, and cost of long-term debt. If the interest cover ratio is more than 6.5, the credit rating will be AA. The cost of debt will be 8%. If the interest cover ratio is between 4 to 6.5, the company will be rated A. Cost of debt is 9%. If the interest cover ratio is between 1.5 and 4.0, the company will be rated BB. And the cost of debt is 11%. That means your credit rating will determine your cost of debt. Next paragraph. The company is currently rated A. Now you need to interpret that. If the company is currently rated A, what is the company's cost of debt?
9%.
Thank you. Summarize financial data. We have the net operating income. We have depreciation. We have earnings before interest and tax. We have the interest, taxable income. We have the tax. Tax rate is 30%. We have the net income and capital spending. Additional information. Market value of equity is 458 million, and of debt is 305 million. Coupler equity beta is 1.4. The beta of debt, before I go there, when we say equity beta, that 1.4 is a combination of business risk and financial risk. Because this company is financed by equity and debt, the equity beta is 1.4. The beta of debt may be assumed to be 0. The risk-free rate is 5.5%. And the market return is 14%. The company's growth rate of cash flow may be assumed to be constant and to be unaffected by any change in capital structure. Please asterisk these points. Growth rate is constant and is not affected by change in capital structure. Please asterisk these points. Requirements A. Determine the likely effect on the company's cost of capital and corporate value. If the company's capital structure was 1, 80% equity, 20% debt. 2, 40% equity, 60% debt by market value. Recommend which capital structure should be selected. Please avoid touching my screen. Now, if I ask the class, to what extent do we understand the requirements? Because you need to understand what the examiner says you should do. You want to look at the effect on the cost of capital of this company and on corporate value. If the capital structure is 80% equity, 20% debt, or 40% equity, 60% debt. For me to know the effects, I will now ask myself, what is the company's capital structure currently? What is the company's capital structure currently? What is the company's cost of capital currently? What is the company value currently? I will now ask myself, okay, if the capital structure currently is different from 80 to 20 or 40 to 60, that means there's a change in capital structure. My starting point is to establish the existing capital structure, the existing cost of capital, and the existing corporate value. I cannot look at the effect of change in capital structure on cost of capital and corporate value. We cannot go to expected solution. We can move to expected solution. Please. Get your writing material. Assume you are in your physical class, because the question will be solved here. Your working number 1. Determine the company's existing capital structure, gearing ratio, cost of equity, and weighted average cost of capital. The weighted average cost of capital represents the cost of capital of the company. So let's go to it. Look at the additional notes. Look at the additional notes. Market value of equity, 458 million. And of debt, market value of debt, 305. Let's pick these. Equity value, 458. Market value of debt, 305. This is the current capital structure. Please sum up. What do you have? Please sum up. What do we have?
763.
763. That represents total value of company. Now let's get percentage. That is the gearing ratio now, or gearing percentage. Look at equity. Equity is 458 out of 763. If you want to get the percentage of equity now, look at let me show it here. Equity percentage, 458 over total company 763 multiplied by 100. That will give you the percentage of equity in this company.
60%, sir. 60%.
Equity is 60%.
60%, sir.
Correct? Now go to debt. Your debt is 305 over 763 multiplied by 100. That should give us
40%, sir.
Can you see it? Currently, the capital structure of this company is equity 60%, debt 40%. Any question, please? Of course, no question. This is straightforward. The current capital structure contains equity 60%, debt 40%. Our next working. We need to calculate the cost of capital. To calculate that, I must know cost of equity. Because this company is financed by equity and debt, I must know cost of equity, I must know cost of debt. We need to calculate the existing cost of capital. Based on this capital structure, for me to calculate cost of capital, I require cost of equity. I require cost of debt. Now let me ask the class, how do we calculate cost of equity? Let me ask the class, how do we calculate cost of equity? Any idea?
Yes.
Yes, we are listening.
Okay. Cost of equity is equals to the risk-free rates minus beta brackets risk premium multiplied by risk premium.
Okay.
We
Thank you, sir.
also use, since information on dividend is not given, and then
I can't get that. Sorry.
information. I said, since information on dividend is not given, we use Gordon's. No, it's the same capping that we use. That is the risk-free rate minus beta times risk premium.
All right, thank you, sir. I think you answer it very well the way I like. There are two ways of calculating cost of equity. You can use dividend valuation method, or you can use capital asset pricing model. Examiner may specify the method to use. Why in some questions, the examiner will not tell you the method to use. Examiner will only provide you with data. Like this question. We are not told which of the method to use, but we are given the equity beta 1.4. We have the risk-free rate 5.5, and we have the market return 14%. With these variables, you can use CAPM method to compute your cost of equity. The CAPM formula has been stated for us. Let's go and work this out. That means our cost of equity is equal to risk-free rate 5.5 plus beta. The beta of this company is 1.4 currently. Bracket return on market 14 minus risk-free rate 5.5. You can get existing cost of equity. Please work this out. Please work this out. Final answer?
17.4%.
17.4%. Thank you. Next, we need to determine the company's cost of debt. The question says the company is currently rated A. and the cost of debt is 9%. But we need to calculate cost of debt after tax. When computing your WACC, you calculate cost of debt after taxation. This 9% is before taxation. And please note, unless the examiner states otherwise, the cost of debt given the question is before taxation. Unless the examiner states otherwise. The cost of debt is assumed to be before tax unless the examiner states otherwise. You can come here now. Cost of debt net of tax. Out of this 9%, I need to remove tax of 30%. Look at how to do it. 9% multiplied by 1 minus the tax rate minus T. That becomes 9% multiplied by 1 minus 0.3. Please work this out. What is the cost of debt after tax?
6.3.
6.3%. You can now proceed to calculate your WACC. You have different formula of calculating weighted average cost of capital. You have different methods of calculating WACC. But all the method must give you the same answer.
Please, on the 7th.
Please, can you mute? Hussein, please, can you mute? Thank you, sir. Let me repeat that. You have different methods or different ways of calculating your weighted average cost of capital. But all the methods will give you the same answer. You recall our class last week. We stated like two, three formula. You can use this one first. You can also compute your WACC as let me remove this. Your WACC can be calculated as cost of equity multiplied by percentage of equity plus bracket cost of debt after tax multiplied by percentage of debt. I can use this. Both methods will give me the same answer. Look at the first formula. Our KE, that is the cost of equity. This is 17.4%. Our VE, this is value of equity. Value of equity is 458. Our KDT, there's T here. KDT, cost of debt after tax. This is 6.3%. Just trying to create space. Okay. Our VD, this is the value of debt, 305. I can use these 4 variables to calculate my WACC using this formula. I can do like this. WACC is equal to cost of equity 17.5. Okay, let me take it to ratio. (0.174) multiplied by value of equity 458, close my bracket, plus value of debt, cost of debt 0.036 multiplied by value of debt 305 all over value of equity 458 plus value of debt 305. Please work this out. Multiply your final answer by 100 so I get percentage. Please work this out. Let us have your answer.
%12.96%.
Correct. The WACC is WACC is 12.96%. Based on the existing capital structure, WACC is 12.96%. You can use the second formula, or I can do like this. WACC is equal to cost of equity 0.174 multiplied by percentage of equity 60% plus cost of debt 0.063 multiplied by percentage of debt 40%. If you check this out, you are still going to get 12.96%, whichever method you choose to use. We have gotten the WACC. Based on the existing capital structure, 60% equity, 40% debt. This company's cost of capital is 12.96%. And this company total value is 763 million. It's there. So where is the value? Look at the value. Total value of this company, 763 million. Any question, please? All right. Now, look at the new capital structure. Please look at the new capital structure. Let me increase this more. Yeah, please. What can we see? 1, 80% equity, 20% debt. What has happened to the capital structure? Hello, guys. What has happened to the capital structure?
Equity has increased, debt has reduced.
Thank you. That means there's a change in the capital structure. Equity has increased. Debt has reduced. That means the gearing ratio has changed. The capital structure has changed. Please note, like I explained last week, once you observe that a company capital structure has changed, that is, the gearing ratio has changed, the first thing you are going to do is to ungear the company. Ungeared means remove the existing debt. Ungeared means remove the effect of the existing debt finance. Look at this now. Ungeared also means convert your equity, this equity beta. The equity beta of 1.4 is the beta for business risk and financial risk. Look at the comments here. A change in gearing will result in a change in equity beta. Assuming that the debt beta is 0, ungear the existing equity beta. When we say ungeared, it means convert the existing equity beta to asset beta. When we say ungeared, it means convert the existing equity beta to asset beta. By converting it to asset beta, you are removing the effect of the existing debt finance. You are going to convert this using the existing gearing ratio. The gearing ratio is 40%, 60% equity, 40% debt. So remove the effect of the existing gearing. Let's demonstrate this. I'm very sure you are going to do more of this in your cost of capital computation. Asset beta. This is what we are trying to calculate now. Equity beta of this company is currently 1.4. Market value of the company is 458, or you can use 60%. You can use whichever one is convenient. Debt beta is 0, assumed to be 0. Market value of debt is currently 305, or you can use 40%. The tax rate is 30%. We can get the asset beta now. We come here, our beta of assets is equal to, for convenience, I'll just pick percentage. This is 60. Oh, sorry. I should start with BE, equity beta 1.4 multiplied by value of equity or percentage 60 over value of equity 60. Yeah, Minister for Finance plus value of debt 40.
I thought we were
1
using
minus the
equity
tax rate
percentage.
0.3. Your line is breaking, oh.
I thought we are using the new percentage of equity and debt.
I thought,
Like we are using, are we still using the old percentage of the equity and debt?
okay, listen to this. For you to ungeared, you want to remove 60-40. Ungeared means remove the existing gearing. When we say ungeared means remove the existing gearing ratio. If you are ungearing, look at the meaning. Ungeared, meaning remove the existing gearing ratio. The existing gearing ratio is 60% equity, 40% debt. Is that better, please?
Very clear, sir.
When you say ungeared, it means remove the existing financial gearing ratio. Now look at this. I should have plus here. Now look at this place, please. BD, debt beta or beta of debt is 0. If this value here is 0, 0 multiplied by any number will give us 0. That will make all this figure here to be 0. You don't need to waste your time going to the other part of the formula. Because we have been told to assume that beta of debt is 0. Everything here is what? 0. Now, please work this out. Give us our BA. If you work it out correctly, you should have 0.9545. Please give me what? Yes, please, somebody should confirm. Yes, please.
Confirm, sir.
Confirmed.
0.9545.
Right. You observe that the figure has reduced. Before, the equity beta was 1.4. Now that we converted to asset beta, we have removed the financial risk. Definitely, the figure will go down. Just 1 minute. I'm trying to take water. All right, let's go on. You have ungeared now. Your next working now. You know, we said ungeared. You have removed 60 equity, 40 debt. Your next working now. If the gearing was 80% equity, 20% debt by market value, the asset beta may be re-geared. Look at it now. You are now going to re-gear now using 80% equity, 40% debt, so to obtain new asset beta. Finance minister, look at it now. We have removed 60%, 60 equity, 40 debt. We are now going to re-gear. We are going to re-gear with the new capital structure percentage. Re-gearing means convert asset beta to equity beta using the new gearing ratio. Now come here. Look at it. Please look at it. Our BA, this is 0.9545. That is the asset beta. Our BD, debt beta is 0. Value of debt is now 20%. Value of equity is now 80%. The tax rate is still 30%. I can use this variable now to get my new asset, new equity beta. Beta of equity, look at the formula, is equal to BA 0.9545 plus, open a bracket, BA 0.9545 minus 0. Value of debt is now 20. Value of equity is now 80. Bracket 1 minus 0.3. Tax rate. Please work this out. For convenience, I can do like this. 0.9545 plus bracket 0.9545. 20 divided by 80. That will give you 0.25. 1 minus 0.3. That will give you 0.7. Now work this out. What is the equity beta? If the ratio is 80% equity, 20% debt. You should have something like 1.122. I'm not wrong.
Confirm 1.121 or 0.2.
1.122
approximately.
Approximately.
Yes.
Can you see it now? As a result of changing capital structure, the equity beta of the company has changed. Your equity beta, let me repeat it, is a measure of business risk and financial risk. Once you have gotten a new equity beta, because the equity beta has changed, that means the cost of equity will now change again. At 80% equity, 20% debt, our beta is 1.122. That means our cost of equity will change also. Based on 80% equity, 20% debt, recompute cost of equity. Look at it. KE is equal to RUF 5.5 plus, now your beta is now 1.122 bracket RUM 14 minus RUF 5.5. What is the cost of equity now? The risk has reduced.
%15%.
What is it?
15%.
15.04, I guess, but
That's
we can
correct.
approximate. 15%. Can you see it? Based on 80% equity, 20% debt, our cost of equity now is 15%. Next, look at Roman figure 2. If gearing was 40% equity, we have worked on 80% equity, 20% debt. Now let's look at the second scenario. If gearing was 40% equity, 60% debt by market value, then we also need to re-gear now. We have re-geared based on 80-20. Again, we are going to re-gear based on 40-60. When we say re-geared, we are going to re-gear the asset beta calculated in our working one. This asset beta, that is the business risk. We now want to introduce the financial risk to it based on equity 40, debt 60. I have to re-gear now again. I'll come here. Again, state the formula. Re-gearing means convert asset beta to equity beta. Look at the formula. Equity beta is equal to BA asset beta plus bracket BA asset beta minus BD debt beta, value of debt by value of equity, 1 minus the tax rate. My BE is equal to asset beta is 0.9545 plus 0.9545 minus debt beta 0. Value of debt now is 60%. Value of equity is 40%. 1 minus tax. Work this out. Our BE is equal to 0.9545 plus brackets 0.9545 60 divided by 40. That will give you 1.5. 1 minus 0.3. That will give you 0.7. Please recompute based on 46. What do you have? You should have like 1.9 something. I'm not sure, sir.
$1.96.
1.95 something. 57, I guess.
That's correct.
This is 1.957. Look at it again. Because the gearing ratio has changed, the risk of the company has changed. And once your risk change, then your cost of capital, your cost of equity will change. The beta has changed. You have to recompute cost of equity again. Look at this. ROF 5.5 plus new beta 1.957 bracket 14 minus 5.5. What is cost of equity now?
22.135.
22.135. Let's do small summary. Let's do summary small. Summary. At 60% equity, 40% debt, we have at 80% equity, 20% debt. Then we have at 40% equity, 60% debt. Here, cost of equity. Here we have 17.4%. Here we have 15%. Here we have 22.135%. WACC. Here we have 12.96%. Corporate value. Total value is 763. Look at it. We still need to calculate WACC under 80% equity, 20% debt, as well as under 40% equity, 20% debt. For me to calculate WACC, because the gearing ratio has changed, we need to recompute weighted average cost of capital. This 12.96 is based on 60% equity, 40% debt. Now that the ratio is 80%, and compute your WACC. All right. How do we go about this? We have gotten cost of equity. we also need to get cost of debt. If you go back to the question, cost of debt is dependent on interest cover ratio and the credit rating. All right, let's continue. I hope it's clear.
Yes, sir.
From this question, if you look at the question, our cost of debt is based on credit rating. The company is currently rated A. So we selected 9%. Now that, if you look at this, debt has reduced here. That means the rating will change. Look at this scenario. Debt has increased. That means the rating should change also. We need to work this out. How do we go about it? First, scenario 1, debt is 20%. Calculate new debt value. Please, total value of the company is 763 million. It contains value of equity and value of debt. Now that debt is 20%, please compute 20% of 763 million. What is the new debt value? Hello?
153 million.
152.6. Yes. This will give us 152.6 million. Out of total value of the company, debt is 20%. That means the debt value in naira amount or in dollar amount should be 152.6. Now look at second scenario. Debt is now 60% of total value. Compose 60% of 763. What is the debt value here?
457.8.
60% of 763 million.
457.8.
457.8 million. Thank you. In the first scenario, value of debt reduced. Second scenario, value of debt increased. Let me close this up. Examiner says cost of debt is dependent on interest cover ratio. That means it computes interest cover ratio. Let me take you back to that aspect. Look at it too. Is aware that as gearing increases, require return to shareholders the required return on equity will also increase. The company's interest cover is likely to decrease. Decrease in interest cover could lead to change in company's credit rating. We are now giving the guidelines. That means if your rating is, if your interest cover is above 6.5, you'll be rated AA. Your cost of long-term debt is 8%. What the examiner is trying to tell you is that you need to know the interest cover ratio, then determine the credit rating, and pick the cost of debt. Okay. So my question to the class is, what is interest cover ratio? How do we compute interest cover ratio? Yes. My question to the class is, what is interest cover ratio? Oh yeah. Minister for Finance.
It used to be profit before interest and tax over interest expenses.
Okay. It's calculated as profit, earnings before interest and tax divided by the interest expense. That's correct. Your interest cover ratio shows the number of times your operating profit cover interest expense. Now let's go to the question. What is the profit before interest and tax? Let's look up. Earnings before interest and tax, 90 million. Pick that figure. This is 90 million, 90 million. Now, interest, assuming the rate is still 9%, compute 9% of our new debt, 9% of 152.6.
13.734.
13.734. Come here also. 9% of the debt is now 457.8. Compute 9%. What do you have? What is the interest expense?
41.202.
202. You can calculate interest cover ratio now. PBIT divided by the interest. 90 divided by 13.734.
6.55.
This is 6.55 times. It's calculated in times. Let me put it here, times. Calculate what do you have here?
2.18.
Now, if the interest cover ratio is 6.55 or 2.18, what is the company's rating? Please look up. More than 6.5. The company is rated what, please?
AA.
AA.
What is the cost of debt here?
8%.
Good. If the ratio is between 1.5 and 4, this is where 2.18 will lie. Is that not?
That's correct.
What is the rating here?
11%.
BB, thank you. We can go back now. Rating here is AA. Rating here is BB. Cost of debt is 8% here. Cost of debt is 11% here. This is before tax. To compute my WACC, I require after tax. I can now say cost of debt net of tax. I can compute the first one. That will give me
5.6.
for the first one, 8% multiplied by 1 minus the tax rate.
30%.
I can even do like this. I can do like this. Of course, it will still give me the figure. I'll just do like this. Tax, 30%. Compute 30% of 8. That will give you 2, Abby.
2.4.
2.4. Oh, okay.
So it's not the same.
Why not? Should be the same now.
The other one is 5.6.
And don't worry now, it will give me the same thing now. This will give me 2.4. Now get 8 minus 2.4. That will give you cost of debt after tax.
Okay, you're right. 5.6.
It must give you the same thing now. Come here. 30% of 11. What do you have?
3.3.
3.3. 11 minus 3.3.
7.7.
7.7. That is when we just remove the tax.
That's correct.
You can compute your WACC now. Weighted average cost of capital at 80% equity, 20% debt. I'll just come here. Second formula here we work with. I can just do like this. Cost of, WACC. WACC is equal to cost of equity multiplied by percentage of equity plus bracket cost of debt after tax multiplied by percentage of debt. Based on 80-20, cost of equity is now 15%, 0.15. Percentage of equity is 80%, 0.8, plus cost of debt after tax, that is at, this is 0.056. Percentage of debt is now 20%, 0.2. Please work this out. What is WACC? you should have multiply your answer by 100. Your WACC should be 13.15. I'm not mistaken. Based on 80% equity, 20% debt.
Okay, I got 13.12%.
13.12.
12.
And it's rounding off effect now. No, this 15% is 15.04. That's minor. It's the effect of rounding off figure. Come here. WACC at 40% equity, 60% debt. WACC become at 40% equity, 60% debt. Our cost of equity is, the formula is KE multiplied by percentage of equity plus KDT multiplied by percentage of debt. KE is 22.135. Percentage of equity is now 40%. KDT is 7.7%. Percentage of debt is 60%. You can compute our WACC. WACC is equal to, let me create just one like two space. Carries. WACC is cost of equity, open a bracket, 0.22135 multiplied by percentage of equity, 0.4 plus cost of debt after tax, 0.077. Percentage of debt, 0.6. Please work this out. Multiply by 100 should give you 13.447.
That's correct.
47. Correct.
What it means is that capital structure has impact on cost of capital company, on WACC. This is looking at traditional theory now. A company capital structure will affect your weighted average cost of capital. We can go back to the summary we have. Our summary. Yeah, this is summary side. Oh, Look at it now. WACC is 13.15 year. WACC is 13.47 year. Look at the effect now. Examiner say determine the effect of changes in capital structure on cost of capital. If you change, if the company, before the company was 60% equity, 40% debt, attempt to change to 80% equity, 20% debt, WACC will rise. Attempt to reduce debt and increase equity, cost of capital will rise. Attempt to increase debt and reduce equity, WACC will also rise. All be your comments. We still have corporate value to deal with. Look at the comments. The two alternative capital structure are expected to increase the cost of capital from its current level. And if your cost of capital is increasing, your value is likely to fall. We have looked at the effects of changes on WACC. What is the effect on corporate value now? I have like 15 minutes. Look at the other aspect of the question. Please look at this aspect. It said, recommend which capital structure should be selected. It is better to use the existing capital structure, because at the existing capital structure, cost of capital is lower. Now look at the second part. Any change in capital structure will be achieved by borrowing to repurchase existing equity, or by issuing additional equity to redeem existing debt as appropriate. That's not too important to me now. The current total firm's value, bracket open, value of equity plus value of debt, is consistent with the growth model. Cash flow in year one, that is CF1, divided by K minus G. Apply on corporate basis, where CF1 is next year free cash flow. K is the WACC. G is the expected growth rate. The company free cash flow is estimated using earnings before interest and tax minus, into bracket 1 minus tax, plus depreciation minus capital spending. Now, the examiner gave us a clue. Corporate value is consistent with growth model. meaning that you can use this growth model to calculate value. Let's go and demonstrate. Let me go and explain this. Okay, look at it. Corporate value is calculated as cash flow in year 1 divided by K minus G. This can be restated as cash flow in year 0 into bracket 1 plus G divided by K minus G. Examiner says to get your free cash flow is calculated as earnings before interest and tax into bracket 1 minus tax plus depreciation minus capital spending. Examiner in this question provided enough clue. He said K is the WACC. Examiner said K is equal to WACC. G is equal to growth rate. That means I can estimate value now. Under the 2 new capital structure, once there is a change in your WACC, yeah, your value must change. Our CFO, cash flow now, go and pick it. What is earnings before interest and tax? 90 million. Bracket 1 minus tax. What is tax? Tax rate is 30%. Plus, go to the question. What is depreciation? $20 million. What is capital spending? 20 million. Examiner gave us a clue on how to calculate value. Plus depreciation, 20, minus capital spending, 20. Please, what is free cash flow in year 0? Work this out. Here I have 63 million. That means I have gotten cash flow.
Correct.
I have gotten cash flow. And we have computed the WACC. You have computed WACC under the 2 scenarios. 80% equity, 20% debt. Or 40% equity, 60% debt. You have computed WACC. What is growth rate? Examiner also gave us a clue. I said asterisk that note. Look at that note. The company's growth rate of cash flow may be assumed to be constant and to be unaffected by change in capital structure. That means the growth rate is the same based on existing capital structure or new capital structure. The growth rate is the same. So you can go and estimate the growth rate based on existing value. Look at it, please. Look at this. The growth rate is unknown. However, existing corporate value, company cash flow, and WACC are known, allowing the growth rate to be estimated. Look at it, please. This is what we are saying. Value is cash flow in year 0, 1 plus G over K minus G. Currently, K, need to create space here. I'm almost done. I imagine let's go to it now. Currently, value is, total value of the company is, currently 763.
763, yeah.
WACC is currently K, that is WACC. WACC is currently 12.96%. Cash flow is 63. What is G? You can substitute. How is he moving with it, man? Okay. You have to leave there now. Why is he giving us this one now? Okay. Value is this. Okay, I can come here. 763 is equal to 63 bracket 1 plus G over WACC 0.1296 minus G. What is G? Why am I having this now? Oh, wow. And I'm almost done. Oh. Wait. I'll suspend everything. Let me copy it here. Please hold on. I'm trying to see where the problem is coming from. Let me try again. Okay, the system is angry. Please hold on, it's trying to save. Oh, I see. Please hold on. Okay, let me see now. What we are trying to get here is we want to determine value of G, growth rate. With this equation now, I'll just cross multiply. Why this thing sticking here? No. Oh, I don't like this. So. Let's see this.
Sir, did you freeze the test?
Why will I freeze it now? Why would I want to freeze it now? Let me do something. Let me try again. So I should have something like this. 763 is equal to 63 bracket 1 plus G over cost of WACC 1.296 minus G. If I cross multiply, I'm going to have 763 into bracket 0.1296 minus G is equal to 63 brackets 1 plus G. I can do like this for convenience.
It seems you will have to do this, undo the adding of lines. That's where the issue is coming from.
Okay, let me do something. Just that when the time is gone, I will adjust. Where did it even stop now? Just 1 minute. I'll just remove you. Let me do something to round. That would be risky. Let me just do something here. I need to explain that and round up this class. This is what I'm trying to explain. Look at the whiteboard. Look at my whiteboard. I have something like this. Oh, why now? Okay. I have something like this. 763 is equal to 63 bracket 1 plus G over 0.1296 minus G. I will cross multiply. 763 bracket 1.96 minus G is equal to 63 bracket 1 plus G. I can do like this. Divide by 63. Divide by 63. This will knock out this first. 763 divided by 63, what do you have?
12.11.
12.111. 12.111 into bracket 0.1296 minus G is equal to 1 plus G. Now open the brackets. 0.1296 multiplied by 12.11. What do you have, please?
1.569.
1 point. Is that correct?
Yes, sir.
0.1. Okay.
12.11 times 0.12.
0.1296 multiplied by 12.11.
Yes, 1.569.
569 minus 12.111 G is equal to 1 plus G. I can collect light terms. move 1 out here. 1.569 minus 1 is equal to G plus 12.11 G. This will give me 0.569 is equal to 13.11 G. G is equal to 0.569 divided by 13.11. Work this out. G will give you 0.043.
Correct.
Check it out.
Correct,
However
sir.
you do it, you are going to get 0.043. Once you get the growth rate, you can calculate value. If you go to at the first scenario, 80% equity, 20% debt, value becomes, look at the formula, 1 plus G over K minus G. This becomes, our cash flow is 36. Bracket 1 plus G. G is now 0.043 over, our K is the WACC. Under new capital structure, 13.15. That will give me 0.1315. Minus the growth rate, 0.043. Work this out. What is the value? There's going to be a value here. Check the second one, second scenario. 40% equity, 60% debt. The only thing that will change is the WACC. Value is equal to 36 brackets 1 plus the growth rate, 0.043. WACC is now 13.47 minus 0.043. What is value here? Yes, any answer? It should be 17 here. It should be something like, what's the value here?
742.
Yeah, 742. Yeah. You observe that the two capital structure change to, we reduce the value. Sorry, I don't like going beyond that 11. But I was forced to do this now. If I return back here now, but this was malfunction. I don't know why. If I come here now, value here is now 742,717. So which of these capital structure are we going to recommend?
The existing
Should the
capital
company change or not? Maintain your existing capital. At the existing capital structure, 60% equity, 40% debt. WACC is 12.9. 6. Value is 763 million. Any attempt to change the gearing ratio will increase cost of capital and reduce value. This is the traditional theory. It's saying that once you achieve an optimum level of gearing, do not change your gearing ratio again. The traditional school states that every company has an optimal level of capital structure, where WACC is at the minimum and value is at the maximum. Once the optimal level is achieved, the company should maintain the existing capital structure. Any attempt to change will increase WACC and reduce value. This is the principle of the traditional theory of capital structure. Apology for taking your 10 minutes. Any question, please?
Is this exam question?
Of course.
Jesus Christ.
Hey, Jesus
This is
Christ.
Satima's question. This was tested for 30 marks.
Wow.
This thing is complex, so you need a lot of revision and understanding.
The reason why it might be complex is how far have you gone with cost of capital computation with Mr. Juan?
We just
Have you
did
gotten to
cost
WACC?
of debt yesterday. No, next class.
Have you gotten to WACC?
WACC is next class.
Next class.
Don't worry. What I will advise is try to study it. You may not understand 100%. By the time you get to Juwan's class, you are going to, all things being equal, you are going to understand where we are coming from now. All right, we have to stop the class here.
So I hope we understand so, because yesterday I had to leave him to continue. I had to go and rewatch the broadcast because it was not funny anymore.
I didn't get that part.
You said that once we are through with Mr. Jiwon, we will get to understand this one. And then I was now saying, even yesterday, I had to leave him in the class like that because he was going, my God, something else again, like still cost of capital.
Okay, let me say this. Do you understand the question we are trying to solve?
Yes, up to the point when we started calculating this corporate value.
What are we trying to solve?
The capital, we're testing that theory, the traditional theory that says the company's value. How did I put it?
The line is breaking. You know why I'm asking you this question?
No, sir.
I want to be fair to you and to the lecturer, to the school. I want to be fair to you and to the lecturer and to the school. You got a lot. You need to first of all ask yourself, with all sincerity, what is my level of understanding and assimilation? You know, I only have 2.5 hours in this class. We have to be very sincere with ourselves. We have different learning rates. What we try to do as much as possible is to explain the examiner's question to you first. This question is about texting the impact of change in capital structure on cost of capital and on value. You now ask yourself, how do I compute cost of capital? You need to ask yourself first, what do I require to compute cost of capital? What exactly is cost of capital said? It's just that the time is actually, we have exceeded at 11 p.m. The question is not as complex. Is to identify what is cost of capital first for myself. To compute cost of capital, you must know the types of capital use. That was the first thing we did. Capital structure, type of capital use first. So I'm trying to find a way to put it in a way that you will be able to get the message. If you are calculating cost, if you identify the type of capital, that's okay. Like this question, we have two types of capital. I have equity capital and debt capital. That means for me to calculate WACC, I must know 4 things. Cost of equity, value of equity, cost of debt after tax, value of debt. We look at the question. The first aspect we did, immediately you observe that capital structure has changed. That means that equity beta is no longer valid. And I won't be taking this topic again because once I'm finished with it, I'm going to the next topic. So I will just try to say, if you are still having challenges, because this topic is to complement what the second lecturer is doing. Maybe you might need to now look at it that maybe you privatize the lecturer. Let's see how we can help ourselves. Is that better, please? Shouldn't be this difficult. All right. I'll spend more than required tonight. I will be checking out of the classroom.